Good morning, everyone. So thank you for joining us today on ESMA's webinar on risk article on neo-brokers in the EU. My name is Aleksandra Bojanic. I'm from ESMA Communications team. And before we start with the presentation, I will provide some relevant technical information. So please note that the webinar is recorded and it will be published on ESMA's channels. We will provide the link to the recording and to the presentation to all attendees after the webinar. The Q&A session, it will be held at the end of the webinar, so after the presentations. During the presentation, you can use the Q&A option on the top of your screen and you can provide your questions in writing. Please note that you are all muted automatically and with camera turned off. And during the webinar, you cannot unmute yourself or turn camera on. I believe we can now start with the webinar. We will start with welcome remarks from Mr. Stefan Kern, the head of Economics, Financial Stability and Risk Department. Stefan, please, the floor is yours.
Thank you so much, Aleksandra. Very kind of you to introduce the technical details of this webinar, and from my side, also a very warm welcome to all of you on this call. Thank you very much for your interest in this very specific piece of work that we, in fact, published last week. We looked into neo-brokers in the European Union, of course, a very important topic to all of us who take an interest in consumer protection. But also to all of us who take an interest in efficiency in markets and in the growth of capital markets at large. A hugely interesting topic, super relevant for ESMA, and we are organizing this webinar today to explain our findings and to give all of you here on the call an opportunity to discuss our findings with us and to ask questions, but also make proposals with respect to our future work in this very important area. Clearly, the article examines the recent growth of these very innovative firms, and we look into the activities and business models that they have in terms of real-time trading via online and mobile platforms. Based on recent survey evidence that we have collected, our results actually confirm that most neo-brokers trade volumes that originate from retail clients. So it is really a retail focus that we need to take. It highlights the importance of this topic from our consumer protection angle. And this is one first very important insight into our work for our onward policy activities. The article also considers the developments from the perspective of market structures, and we find that neo-brokers actually adapt their business models to the type of instruments that they trade and often execute orders on smaller trading venues. So this is not just one static business model, but actually a very dynamic environment where we will see or expect to see going forward future additional change in the structures in which these business models are actually executed. And third point, we see a number of risks and benefits, of course, in the system, and many of them have been discussed. ESMA as an organization has communicated on neo-brokers in the past, but clearly the benefits include the promotion of capital markets at large, in particular the participation amongst households and smaller retail clients, through lower transaction prices and the conveniency of services. And then there is also the risk that we've also communicated on in the past by ESMA, which is in particular from the consumer perspective, the fact that if firms facilitate trading and potentially unsuitable products, this might have an impact on the users, and in particular if this is in connection with social media functions, which are in some cases actually integrated into the services of neo-brokers, which may encourage clients to trade without actually being fully aware of the risks and the dynamics of the models of the products that they trade. Now, for a more in-depth account of the article itself, it's my great pleasure to introduce to you Alex Harris, who is a senior economist in our Economics and Financial Stability and Risks Department, who will bring to you the overall findings from the report. He will also subsequently be joined by his co-author, Eugenio Kolesnic, who will participate in the discussions towards the end. After the presentation, we have the pleasure of being joined by Tessa Bode, the policy officer in the Investment Protection and Intermediaries Unit, who will discuss the relevance of these findings from a policy perspective, which is, of course, the core of what we do at ESMA. Subsequently, there will be the Q&A session, which will be moderated by Claudia Guagliano. She's the head of our Consumer Sustainability and Innovation Analysis Unit. Now, we will, of course, be very happy to answer any questions that you may have and engage with you in the discussion. Please feel free also to make suggestions to us. We are looking forward to the discussion in particular in order to shape our onward work in this area and give us a perspective of what else we can look at in future. With this, I wish all of us a very interesting event. I thank you very much for your attention again and for joining, and I will hand it over to Alex right now to give us the details on our neo-broker analysis. Thank you, Alex.
Thank you very much, Stefan, for the introduction, and welcome from me as well to all attendees. I co-wrote the article with two other authors, one of whom is here, as Stefan mentioned, Eugen. He'll be available for the Q&A later on. But it's my pleasure to introduce the work that, as mentioned, has been carried out, much of which based on recent survey evidence. So we carried out a survey within ESMA and with our competent authorities last year, surveying a number of firms, which I'll come on to. But first, to set the scene, some results using commercial data to help us understand the overall context in which neo-brokers have been developing in the EU and elsewhere. So we've seen a new phenomenon, effectively, which is this generation of digital financial entities. They enable consumers, and as we found, indeed it is mostly retail investors, to trade real-time in financial products. So this is not a formal legal definition. There isn't, to my knowledge, a legal definition of the phenomenon, but I think it's nonetheless a well-identified and well-understood sort of natural phenomenon. So when, for instance, selecting firms to sample, it's usually fairly clear from looking at the offerings they have and the facilities they offer online that they are what we mean by neo-brokers in this context. And I think it's also worth just thinking how radically different the services that neo-brokers offer are compared to what came before, or what might have been a more traditional offering or brokerage service. For instance, it's possible to download an app to go through automated checks for your identity, and for instance, also in line with anti-money laundering requirements, you could upload perhaps a identity document such as a passport, maybe take a selfie to help verify who you are, and you can be online and with access to a wide range of different financial products to trade in a matter of minutes. So it's really very different to the old world where, which of course is still in place to some extent, where customers would go into their bank branch, say, and discuss with an advisor, or perhaps use a telephone broker. So that's really a very different sort of experience or environment that the clients are involved in now. And we also see increasingly how the offerings online from neo-brokers are integrated with other features. So there can also be, for instance, an online community of users who may be able to interact and share information also in real time or on message boards. So we've seen, from a market-wide perspective, a rapid growth in the client assets among these firms from a low base, as it's a recent phenomenon. Globally, just very roughly, the commercial data that we've seen estimates around €1 trillion of client assets globally. That's relatively small compared to other segments of the financial sector or financial markets. So for instance, it's not perhaps completely comparable, but we know that investment funds, assets under management are in the tens of trillions, perhaps 60 or 70 trillion euros globally. So from a system-wide perspective, it remains quite a niche part of the market. Nonetheless, the use of neo-brokers is quite widespread. So if we look at the second chart below, this takes the number of accounts, again based on commercial data, and it estimates what coverage there is as a share of the total adult population in each country using public data. And that is, I think, quite an interesting result. So we see, for instance, in the US, on that measure, perhaps as many as a fifth of the adult population have neo-broker accounts. Now, that probably overstates the true picture. There could be, for instance, dormant accounts, and there may be many cases also where consumers have more than one account themselves. Perhaps they use one more frequently, or indeed actively use more than one. But nonetheless, just as a rough picture, it shows that we have widespread coverage, even if systemically the amount of assets being traded is perhaps less significant than other sectors. We see also some famous names. I think eToro is a well-known neo-broker which has a presence in Europe. Robinhood is US-based. Trade Republic is also an EU German-based firm. The figures we have here for the valuations are, I think, rather approximate, but again, they're based on public information, so they are either based on public private funding rounds, or they're based on public market capitalization. So the reason that we have been looking increasingly at these developments in recent years is that we firstly have a responsibility as an authority to understand how the market is developing and understand potential changes in market structure. That could, of course, ultimately affect the conditions in which trading takes place. We've got quite a number of new entrants, and we'll see later, and as anticipated, there are some interesting effects, I think, on where trading is rooted and how trading takes place. Another phenomenon that we had seen in recent years was payment for order flow. Now, this is where a firm would receive payment from a venue for directing client orders to that venue. This is a practice that ESMA warned on in 2021, as there are several risks, including potential conflicts of interest, and also the potential for limited transparency, where consumers may not be made fully aware of exactly how the arrangement works. Given that, we've actually had since then an EU-wide ban on the use of PFOF. However, there are some transitional provisions in place. So where PFOF arrangements were existing, they can continue for another 2 years. Neo-brokers, I think, are very innovative users of technology, as I mentioned. We have seen examples where the features they offer are gamified, so they may be very appealing, but they also perhaps include features that are separate from the trading or the returns or the risk profile of the products. So they're more meant to engage the user, make the product seem appealing, which can have a dark side to it. There's a concept of dark patterns, which ESMA published a discussion paper late last year, but also a number of other investor protection aspects. I'm not going to go into detail on those. My colleague Tessa, who will be giving a reaction at the end of this presentation, I think has been leading work in that area and can give you some more insight there. There's also, I think, on the positive side, the potential to use this new technology to promote household participation in capital markets. ESMA published a position paper a couple of months ago and sets out, among other things, recommendations to try to encourage EU citizens to help realise their long-term financial goals through investing and by participating more in capital markets. That's also linked closely to the European Commission's Capital Markets Union initiative. So I would encourage you, if you haven't already, to take a look at the ESMA position paper. I'll move on now to our novel findings, which are from a survey that was conducted in 2023. There were 27 EU-based firms, neo-brokers, as I mentioned, that identified through a sort of common understanding of what we're referring to without a legal definition. And they were authorised by 11 national competent authorities. The firms within the sample, as mentioned, based on supervisory judgments, are identified. They have a large coverage in terms of client numbers. There are around 10 million client accounts. Most of the clients are from the EU or the EEA, and 3 firms were providing nearly 3/4 of the accounts. So, as mentioned, it's a fast-moving market, but we've seen some degree of concentration in market share. There's a range of different services and products offered. This was part of what was asked to the firms in this survey. We've seen, of course, the automation and use of innovative features is an important part of their business model. They aim to use online-only offerings partly as a way to attract clients. It also can be cost efficient. They may also offer different services. So as well as executing orders, they can be portfolio and wealth management services or advice. They can also offer custody and safekeeping of assets. And the most common types of instruments traded include ordinary shares as well as ETFs. Additionally, fractions of shares or fractional shares or other contracts that replicate ownership of shares in ETFs. So this is an area also where ESMA has been active in considering the qualification, for instance, of different types of fractional shares, which can count as derivatives. Also, CFDs is another area ESMA has focused on in the past, introducing leverage limits under MiFIR product intervention rules in 2018. Those limits have become on a permanent basis across the EU at national level. And in addition to the leverage limits, there are some other safeguards and important measures in place to protect investors around CFDs, including risk warnings and measures to stop investors owing more money than they invest if the trade goes in the adverse direction. Derivatives are also offered, and then an important part of the market is crypto assets as well. Clearly, crypto assets come with their own risk profile and some quite severe risks in some cases to investors, and it's another area where ESMA has been active in warning investors, among other things. Now, one interesting, I think, finding we had as well is that the business model and the way that firms execute orders often depends on the instrument type. So we've seen on-venue execution taking place for several types of instruments, but also in some cases the neo-broker themselves acts as a counterparty and executes orders over the counter. That can often take place, for instance, with fractional shares, which I mentioned. So one consequence of that can be that investors may purchase a fractional share, but then may find it difficult to exit the trade by, say, transferring their holding to another broker because they have a bilateral contract with the first broker. So they would have to exit their position if they wanted to change provider, which adds some friction to the market, to the consumer market in that case. From another important aspect for investors, of course, is costs and charges they face. There are a range of different sources of revenue for the firms. There can be order-based commission. There's typically a bid-ask spread on assets, as you would see in financial markets generally, of course. There can be FX conversion fees. Payment for order flow, as mentioned, was, I think, around a third of the firms mentioned the use of PFOF, or payment for order flow. However, this is in the process of changing. There are transitional provisions there till June 2026. when those expire, then no PFOF would be permitted in the EU. There can also be a variety of other additional types of fees and costs. There is, I think, quite an interesting set of results around the concentration of the market within our sample of firms. So we see, for instance, that especially in the market for crypto assets, 2 of the firms among the 27 made up 97% of volumes, and this was up in 2021, 2022, and these are the 2022 figures. CFDs were also highly concentrated, 3 firms providing 86% of products by volume, and 5 firms for shares and ETFs, which are the most traded asset class, with 90% of total trade being among 5 firms. Nonetheless, from a bigger perspective, this is only a small fraction of total trade volumes within the EU. So if we take shares, for instance, only around 1.5% of total volume of shares traded in the EU are done via these firms in question. Looking at the top chart as well, we see around, in 2022, around half of the shares that were traded were European or EEA issued, and around half from the US. We saw the share increase somewhat from 2021 to 2022, and the rest of the world making up a minority, perhaps around 10% of the value of shares traded. We've also seen some interesting results around what types of venues neo-brokers are routing trades to. So for instance, if they're trading shares or ETF shares, they can often act as an intermediary. So this is the first of the 2 execution models mentioned on the earlier slide. And we don't have a full picture of this, but we did just, as an illustration, look at the case of a couple of large national trading venues within the EU and a sample of several smaller venues, so 5 in this case. Again, the exact proportion is not the story necessarily, but the point being that we saw a large amount of order flow routed to smaller venues, although some still to these larger venues. Again, this is not a definitive statement of the relative shares of smaller versus larger venues, but the fact that smaller venues are nonetheless often used and used for significant amounts of the firm's trading, I think, is interesting. Now, in a sense, that's a form of fragmentation, and it could affect the spreads that market makers face according to the literature in economics and finance. But it's not necessarily an effect that's bad for investors in that case. So although this is an old paper, it's mentioned because it's really seminal in the finance literature. And it may be that if retail trades tend to be routed to the same small venues and become a large proportion of that trading, it may not actually be an adverse effect for them in terms of spreads. So they may actually find that market makers can charge smaller spreads effectively because retail investors are less likely to have information from which they can profit compared to more sophisticated investors or institutional investors. So I think that's something where we don't have a firm conclusion, but theoretically, at least, and academically, is of some interest. So I've given an account, I think, of recent market developments and touched on a little bit some of the risks and benefits. I'll just recap those risks and benefits because this is an important part of our analysis, and it's also, I think, an area where it will be interesting to hear if participants in today's webinar have views of their own. It's clearly in some case up for discussion exactly how we emphasize different risks or benefits, and there may be other risks or benefits that you're aware of that we could consider too. But a risk is clearly where complex or risky products such as crypto assets are offered to investors. Some investors may not be fully aware of the risks they face, for instance, and while it's good that they have easy access to some trading possibilities. Some of the trading possibilities that they face may not in fact be suitable for them. We also see gamification as a possible risk. So, for instance, you could imagine if you trade on an app, and this is just a hypothetical example, you may see some sort of effect like confetti or fireworks or some other sort of visual animation. That may somehow subliminally give you, as an investor, some sort of reward for what you're doing, which is not actually related to the financial profile that you're facing. So I think that's an important area of focus, and indeed my colleague Tessa will discuss some of these aspects as well. Social media may be integrated into a neo-broker platform. There's a risk that there could be misleading information, rumours, or other unsubstantiated information or even advice being offered. It's also possible, for instance, that in some cases users can do copy trading, which I think presents its own set of risks for investors. So in such instances, if you're an investor, you can choose just to automatically replicate pro rata the trades that other retail investors carry out on the platform. You may see what their previous returns have been and decide you want to follow whatever it is they're deciding to trade in an automated way. That clearly carries risks as well. And finally, it's worth mentioning in terms of risks that there are some products for which you don't in fact have the same rights that you might expect. So if you have a derivative which is described as a fractional share, you may find in fact you don't have voting rights. Now perhaps if it's a very large public company, the voting rights may not be the prime motivation for a consumer to participate, but there can also be this frictional effect where it's difficult or not possible to exit to transfer, for instance, your holding to another broker without exiting the contract by selling, which creates, again, a form of friction. The benefits also, some of these have been mentioned. Retail participation and enabling EU citizens to participate in longer term investing is something which ESMA has produced recently recommendations on. We think that there is the potential for this, for technology and neo-broker offerings to help contribute to this goal. But it really depends, I think, on the type of investing that is facilitated. There's a statement or a sentence towards the end of our article, which is really that we want the platforms to be designed to help investors make well-informed, well-reasoned decisions. I think that's a crucial idea here. Convenience is undoubtedly a major benefit for many consumers. There's also the potential, again, depending on how websites are designed, and it's to be seen, I think, whether there will be any effect in practice, but there's the potential for consumers to improve their financial literacy through online means. And there may also be some benefits in the form of new market entrants promoting competition and putting downward pressure on prices, but we don't have conclusive findings on findings or on the level of competition at this stage. We'd be interested to hear if participants have any information on this as well. So with that, thank you very much for listening to the presentation. I'll pass over to Tessa, who will give a reaction from a policy perspective. Thank you.
Thank you so much, Alex, and good morning from my side as well. So as been introduced already by Stefan and Alex, I work in the Protection of Retail Investors team, and I will also providing some reflections on this article from that perspective. The article, as just also presented by Alex, provides detailed reflection on the developments of new brokers in the EU, and while the insights are, of course, very valuable, we find it also essential to balance the perceived benefits with a critical examination of the potential risks to retail investors. So therefore, one of my first critical reflections with regard to the article is the article notably excludes contracts for differences to CFDs from a more detailed analysis. CFDs are high-risk products that are often prevalent in new broker offerings. Their exclusion in the analysis is a missed opportunity, as a more detailed analysis would be beneficial from investor protection point of view, considering the potential for substantial investor losses. Especially also considering that we have seen cases in which some neo-brokers present CFDs to the clients or potential clients in a sometimes confusing manner, such as listing CFDs together with ETFs and or shares. This makes it sometimes difficult to distinguish for the retail investor whether it concerns the actual instrument or its underlying. Therefore, one of our policy proposals has been that instruments should always be noticeably labeled with the categories to which they really belong, and its labeling with the underlying cannot make it unclear to the retail investors that the instrument is, for example, in fact, a derivative. Another reflection from our side is more of a question, and that is whether the neo-brokers actually have a focus on long-term investing for their clients. So while some neo-brokers do offer investment saving plans and instruments that can promote long-term investing, the reality is often more complex. Many platforms also offer riskier products, such as mentioned CFDs, but also cryptocurrencies, which can attract investors looking for quick gains. When opening the apps as an investor, as already said, some instruments are marketed or given information alongside each other, making it confusing perhaps to some investors what instruments they're clicking on. Furthermore, the younger demographic is often more susceptible to gamification and also tends to trade more frequently, suggesting a short-term focus influenced by these features, sometimes included in the platform, such as gamification techniques, but also push notifications when turned on, which can nudge investors towards frequently trading and potentially riskier trades. Also, the gamification elements such as leaderboards or reward system can enhance this intensity in trading. But there could also be techniques that more actively nudge investors towards riskier products, such as a little pop-up or a little message on the top saying investors like you are buying this specific instrument, or showcasing also trending stocks at that moment can really lead to impulsive and more risky investment decisions on behalf of the retail investor. This is why also we highlighted, for example, in a discussion paper, our policy that suggestion that firms using these types of techniques should really focus on the investor long-term outcomes, since also the increased frequency in trading and also the trading in riskier products can also mean higher costs to investors or potential higher losses, which all in all might not always be a very positive outcome for the investor. We also recognize, of course, that it's not all bad, the gamification and the nudging. We do recognize its benefits. These techniques can be used in a good way by firms and in the best interest for the client. Gamification techniques can be effectively used in education initiatives, so learn by playing. And we do also recognize, of course, the reach that neo-brokers have in able to reach their retail investor, which they're a lot more successful at that we here at ESMA. So they could use that reach to really also look into the education of the investor. But also the use of nudges can be used to guide investors to investment products that fit within their specific risk profile and are aligned with their investment goals, if of course these are known by the firm in question. However, also here we also always ask the critical questions whether these good practices of gamification and nudging of clients in the best interest of their clients, it also aligns, of course, with the interest of the firm in question, since sometimes they are likely to benefit more from increased trading and trading in OTC or riskier products, such as CFDs. Another notion that we looked at more closely as well is, of course, the usability of the apps that the neo-brokers offer. They're all very easy to use to the clients, which also enhanced retail participation on the market. So these are also very, very good things. And we have seen it, also seen it, that opening an account with neo-brokers is often very quick and easy, making it very accessible. However, on the other side, it must also be said that closing an account can be significantly more cumbersome. For example, in one UK study also covering 2 neo-brokers active in Europe, it was indicated that closing account required almost twice as many more actions or clicks as opening one. And this disparity can also trap investors and limit their ability to move their funds more freely. The conclusion is difficult. Neo-brokers have undoubtedly democratized access to financial markets to retail investors, something that we really aim to do here in Europe as well, making investing accessible through every type of household within the EU. And neo-brokers do play a big part in that. They can offer it at a lower cost. It's easy to use and fast to become a client. And the apps are very well made. They have a good reach from social media as well. And also their websites are easy to use to investors. However, we also recognize that this comes with the responsibility to protect retail investors from potential risks. And as said, while the ESMA article provides valuable insight, more detailed scrutiny is needed in areas such as whether the easy-to-use the neo-broker acts actually help and aid investors into making informed and sensible investment decisions. Whilst, on the other hand, we also need to not halt financial innovation and the access to retail, to the market, to retail investors. So perhaps this little conundrum provides for also a fruitful discussion here in the Q&A, and I would like to thank you for listening to my very much zoomed in risks to retail investors, and I pass the floor to Claudia.
Thanks a lot, Tessa, and thanks a lot, Alex, for your presentations on this very important topic. At the moment, there are no questions, so maybe I would ask all attendees if you would like to ask a question, just to write it in the chat. Otherwise, there are no questions, so I would like to really thank all of you for your participation today and for listening to our work. I invite you to look and to read our paper that has been published last week, as Stefan said at the beginning, and see you soon at the next webinar that we will organize at ESMA. Thanks a lot.